Provenance. In the world of art, there's a significant emphasis on provenance, which details the origin story and journey of a piece of art. Provenance influences the value of the artwork, considering elements like the renown of the artist, celebrity endorsements, or ownership, and any historical significance the piece may hold. Our investment strategy with Dimensional echoes this concept of provenance. In art, as in investment management, dollar size matters. Dimensional's colossal presence, well surpassing that even of the Canadian pension plan, attests to its significance within the industry. But what sets Dimensional apart is that it's the only portfolio in the world where you can say that multiple Nobel laureates that have been doing this for 40 plus years work directly on the portfolio that you are invested in. These individuals define modern finance. Their names are in every financial textbook, and their methods and formulas are embraced worldwide. Such is the impact of Dimensional that it attracted the attention of an Academy Award-winning filmmaker. Earl Morris sought to document Dimensional's profound influence on history. The film is called Tune Out the Noise, and I highly recommend it. It speaks to this level of provenance and legacy that Dimensional has brought to the investment landscape. So when you invest with Camber, you benefit from the collective experience of our team, the security provided by National Bank, and crucially, the validation of your investment approach being supported by decades of Nobel Prize-winning evidence and executed by one of the most experienced and storied firms in the industry. Global diversification. Imagine if we redrew a world map, not by geographical size, but by the size of each country's stock market. Many Canadian investors are often startled to discover the relative smallness of our national market, which at 3% is comparable to Australia's. Now consider this. Would you feel comfortable if 80% of your investments were concentrated in Australia? Likely not. At Camber, our dimensional portfolios embrace global diversification. This approach not only aims to enhance performance accuracy, but it also reduces the risk associated with unexpected events. Take a hypothetical example. If you were to construct a portfolio exclusively around automobile companies in the United States of America, your choices would be limited to GM, Ford, and Tesla. But by broadening your horizon globally, a wealth of options become available. Germany, BMW, Mercedes, Porsche; Italy, Chrysler, Jeep, Dodge, and Ferrari; Japan, Toyota, Honda, and many others; South Korea, Hyundai, Kia; India, Jaguar, and Land Rover. A portfolio that is concentrated in one region or one sector is vulnerable to regional or company-specific downturns. By diversifying globally, you not only mitigate these risks, but also position your investments to capitalize on a broader range of opportunities. This principle of diversification ensures that your portfolio is not only robust, but also resilient, prepared to adapt and thrive regardless of how global market dynamics evolve over the next decades. Index investing elevated. Here's the stock market, visualized as a collection of companies, each represented by a dot. Imagine this. In a sea of green dots, large, well-known companies like Microsoft appear as prominent large dots, while many smaller, lesser-known companies are represented by these smaller dots. The traditional approach to investing is straightforward. Select a few companies that seem undervalued, invest in them, and sell them when their prices peak. However, this method has been consistently challenged by evidence collected over the past 70 years. Just look it up. Search online, consult any finance textbook, or ask ChatGPT why the majority of stock picking strategies don't achieve sustained success. It may come as a surprise that the historical success rate of professional money managers is alarmingly low, around 20%. You can find better odds at the casino. But here's the good news. You don't need to gamble on picking winners. History shows that simply investing across the entire market, owning all of the companies, can yield substantial returns. This broad market approach is commonly called index investing. It's celebrated for its numerous advantages. It's low cost, tax efficient, diversified, and really requires minimal maintenance from you, the investor. At Camber, we deeply appreciate the benefits of index investing, yet we believe in a simple yet powerful enhancement that can significantly boost investors' returns. Typically, an index fund is constructed by weighting its holdings according to company size or its market capitalization. The larger the company, the larger its weight in the portfolio. But Does the largest size necessarily correlate with the best returns? Historic data suggests otherwise. So we don't see a compelling reason to weight a portfolio by size alone if size isn't a reliable indicator of superior returns. Instead, we refine the strategy by integrating all the strengths of index investing, its cost effectiveness, tax efficiency, diversification, and simplicity, and elevate it by adjusting the portfolio weightings based on potential for returns, not just the size of a company. This adjustment is grounded in reliable data, showing which factors in companies historically lead to better outcomes for investors. Let's delve in to the historical performance difference of different groups of stocks so we can illustrate the advantages of our approach. The standard benchmark. If we look back to 1928, an investment of $1 in the S&P 500 index would have grown to an impressive $9,487. The S&P 500 is made up of the largest 500 companies in the US. However, when we shift our focus to smaller companies within the US, the results are even more striking. That same $1 invested would have ballooned to $48,959, showcasing a significant difference in return. Finally, let's consider not just the size of a company, but also the price paid for its stock. This is called value investing. We assess stocks based on their relative price, essentially how much we're paying for a share of the company's future profits. Value investing, which has been popularized by the legendary investor Warren Buffett, systematically sorts and ranks companies by price, akin to filtering a product when shopping online. $1 invested in small value stocks escalated to an impressive $152,290. This data robustly supports the notion that investors who strategically tilt their portfolios towards small and value companies can achieve higher returns compared to a straightforward investment index. Now, we showed US data here, but this is proven through Canadian markets, international markets, emerging markets across all different periods of time, and is statistically significant to earn higher returns for investors. The hard part. The most challenging aspect of our job is helping clients stay invested in the stock market. Despite knowing that the stock market rises in the long term, the immediate fear of loss can be overwhelming when it comes to our own hard-earned cash. This chart, stretching back to 1920, vividly illustrates the frequency and nature of stock market downturns. These downturns, characterized here by a drop of at least 20%, define what we call a bear market. While these declines are significant, they are neither unusual nor unprecedented. In the history of the market, we see them over and over again. But what I find particularly compelling about this visual is the overwhelming dominance and duration of bull markets compared to their bear market counterparts. The graph illustrates that the expansive and prolonged periods of growth in green vastly outweigh the relatively brief downturns shown in red. This serves as a poignant reminder that the fear of missing out on substantial gains should outweigh the fear of enduring these short periods of decline. Now, a common inquiry among investors is whether there's a reliable pattern, a signal that tells you that there's an onset of a bear market. And however tempting it is to try and predict the market movements, it's proven to be unproductive. The market is complex, it's vast, and despite our best desires, the future remains inherently unpredictable. One of the most pervasive arguments for staying invested in the market, regardless of fluctuations, revolves around the substantial cost of missing just a few key trading days. Let's examine the data. Consider an initial investment of $1,000 over 25 years, 1999 to 2023. Under consistent market conditions, this investment grows to $6,449. However, the scenario dramatically changes if you miss just a few days. Missing the best week, you decrease from $6,449 to $5,382. Miss the best month, and the value drops to $5,150. Miss the best 3 months, it plummets to $4,546. And missing the best 6 months, it dwindles to $4,185. While the fear of market crashes is totally understandable, the data clearly shows that the greater risk lies in missing out on significant market recoveries and rallies. The stock market, up versus down. If you looked at the stock market every day, what percentage of days would you guess the market is up? 53% of days are positive, 47% are negative, It's a flip of the coin whether you'll see gains or losses. But what if instead of daily, you looked quarterly, just once every 3 months? The picture shifts. 71% of the quarters are positive, but still 29% show a negative result, which is significant. Finally, what if you looked once a year? The markets have finished positive 78% of the time. The longer your time horizon, the more the odds shift in your favor. But the market is not a game of certainty. Even if you do everything right, you're not going to win every day, every quarter, or every year. But the important lesson is that you don't have to win every year in order to see great results. Let me give you an example through tennis. Here's Roger Federer, one of my favorite players of all time. How many individual points do you think Roger Federer won over the entirety of his career? He won 54% of the points he played, which means he lost nearly half of them. How many sets do you think Federer won? 75% of the sets. And finally, how many matches? 81%. The similarity between stock market performance and one of tennis's greatest players is fascinating. The key to becoming a champion, whether in sport or investing, lies in persistence. You keep playing, you stay invested, and you don't let down years or lost points derail the strategy that you're on.